All right, well, welcome everybody to a brand new week ahead. Now, before we get stuck into the calendar for this upcoming week, let's just quickly take stock of where we finished going into the close on Friday. Now, it was a pretty busy but yet boring week last week because it seems like everybody was just watching and waiting for that NFP report that we had on Thursday. And obviously, we had the 4th of July holiday in the US, which meant that trading volume was always expected to die down and get very quiet as we go into Friday. So everybody was just really waiting and watching for that jobs report. And even though the jobs report came in pretty stellar, it wasn't enough to really lift the dollar as much as you would have expected it to when you consider things like positioning and how aggressively short the markets have been for quite a while now. But in terms of overall flows last week, let's start with FX, where the Swiss franc was once again the strongest currency among the pack. The Swiss franc has done exceptionally well over the course of the last few months. If you take a quick look at a quick Swiss franc currency index, you can just see the amount of strength that we had. This obviously started, the big rush higher started with Liberation Day tariffs. And we can see that the markets just hadn't let up in terms of that upside momentum. We had a little bit of a die down going back to May, but the Swiss franc is once again back up on that perch, the strongest currency in FX. It's done exceptionally well. It's obviously taken the place of the dollar and to some extent the yen as well as a safe haven currency, really a favorite among the markets for just hedging against the risk that we've had. It's been an incredibly frustrating currency to trade as well, because if you consider what's going on in the Swiss economy, the fact that they've been struggling with deflation for the last 12, let's just call it 16, 18 months now, and the fact that they've been so blasé about it has been a real frustrating point for the Swiss franc, because normally the S&B would have been out trying to curb some of the strength that we've seen in the Swiss franc, but there's just been absolutely no let up from them. They've allowed it to strengthen, and the markets have basically just kept on buying the living daylights out of it. And once again, last week, the strongest currency on the week. Apart from that, the dollar was for once not the weakest currency on the week. It was in fact the British pound, which obviously saw quite a lot of downside playing out into Wednesday's session when we had some political uncertainty hit the wires. We had the PMQs, and we obviously had Chancellor Reeves having a bit of an emotional moment during the PMQs. The markets took that as a sign that maybe she will be stepping down or being asked to step down, which obviously later the PM came out and saying, no, that's not the case. She'll be around for quite a while. But obviously the political uncertainty was a key trigger for sending gilt yields much higher on the session. We saw a big move higher from 4.43% for gilt yields all the way almost up to 4.7. It was a big move as the markets basically looked towards that political uncertainty and a little bit of fiscal concerns once again. And that obviously sent the pound lower. We did see some recovery after the initial drop to the downside, but the pound was still the weakest currency on the session on the back of that move that we had on Wednesday. Now, apart from that, turning over to the equity space, the equity space was fairly mixed last week. Just across the board, we had European equities lower with the DAX and the Eurostoxx 50 down over 1%. The rest obviously traded in positive territory, but the FTSE just about in positive territory, with US equities and obviously looking towards things like China A50, the star performer for the week. Now, in terms of overall flows, look, US equities have done exceptionally well. It's defied gravity, at least in some people's opinions. We've been very constructive on equities ever since we had Liberation Day tariffs coming out. Yes, it was a big surprise, and yes, the risks isn't over, but it's always so important to keep in mind that the equity market is not the economy, and the economy is not the equity market, right? These indexes, they've been designed to have that perpetual grind to the upside. It doesn't mean it can't suffer more downside. There will always be pullbacks. There will always be downside and bear markets that you need to navigate. But currently, there's a lot still going for US equities. You've got the potential agreement of the new spending plan obviously being announced. You've got the potential for interest rate cuts coming up in the months ahead. The biggest, I would say, problem that we have for US equities in the short term potentially would be a massive blowout in the tariff situation again, which we'll touch on in a second for the week ahead. And apart from that, everybody has kind of now gotten very comfortable with the idea that we're not going to see any type of follow-through or pass-through effect for inflation from tariffs. And the big risk here is that everybody's now assuming that inflation, is moving lower, tariffs isn't going to impact it, the Fed will be cutting rates. What if that doesn't happen, right? If inflation starts making a surprise comeback, that's going to be a real problem for equities to deal with in the weeks ahead, in the months ahead. But that's not for now. For now, we obviously hit a new fresh all-time high last week. We saw a little bit of a downside move going into the close, but that's most likely just a little bit of hedging going into that 4th of July weekend. So apart from that, in terms of yields, had a nice big pop to the upside in yields, as you would expect on Thursday with the better than expected US jobs report. It'll be interesting to see how this closes, or rather opens up after trade, because remember, it was closed on Friday. Treasuries was closed for the 4th of July long weekend, so it'll be interesting to see how they open up. I would expect a little bit of upside treasuries, downside yields, just if we see how the dollar traded. That's probably what we'll see going into the open, but wouldn't really expect a lot of reaction there. And then in terms of the commodity space, again, a super mixed bag here. Most of them traded or closed the week in the green, with platinum being the outperformer, up 4%, and copper being the biggest loser there, down 1%. But again, very little driving these markets from a pure macro perspective at this stage. It's all been very much driven by flow. For the most part, I would say, over the course of the last few weeks. Now, turning our attention then to the week ahead, we've got a couple of things coming up in the week ahead to pay attention to. However, the one that we probably dread the most from a news headline point of view is obviously the July 9th deadline coming up for tariffs, right? Obviously, as most of you will know by now, we had the Liberation Day tariffs being announced at the start of April, and there was a lot of issues with that. We saw the market selling off rapidly, the dollar losing ground, equities losing ground, treasuries losing ground, gold ripping higher. It was a massive move on the back of that tariff announcement. And then there was that pushback from President Trump saying that, okay, fine, we'll give it 90 days for negotiations to take place. And obviously that deadline is coming up on Wednesday, right? July the 9th, that's the deadline. Now we've saw Trump take a strong stance on this in terms of recent remarks, saying that there's absolutely no way that additional deadlines will be announced. But let's be honest, we've heard all of this way too many times. All the countries that they're dealing with have seen him, walk back and push back so many of these discussions. Out of the deal, quote unquote, is what he's playing for, but everybody's just looking through that. So the big question coming into the week then is what's going to happen with this, right? We've got the long-awaited deadline coming up on Wednesday. The markets will want to know, will we get an extension to the deadline, or will the same tariffs that we heard from on Liberation Day, will that be reimposed? Will we have a reimposition of tariffs, but it's going to be lower, maybe at that 10% baseline, or will we see some of those crazy numbers like we saw on Liberation Day? We just don't know, right? So we'll need to navigate Wednesday when it comes. We'll need to see what we get. We'll need to see what type of announcements is released. We obviously have only 2 confirmed trade deals at the moment. That's the one with the UK and with Vietnam. Some of the others have been speculating that we'll get a deal, but who knows? There's the EU, there's Japan, there's India that got a quote-unquote mini deal signed over the weekend. We have South Korea that's in the mix as well. We'll need to wait and see. Now, there's basically a couple of things that we can look for to potentially provide some volatility for us, and this is basically the broad way that I'll be looking at Wednesday. So the markets, I would say baseline expectation right now is that we'll get some form of partial deals like the mini deal we got with India just a couple of hours ago, or potential extensions to that 90-day deadline once again. So deal with some partners, others might get more time, and we might get the reimposition of that very low baseline 10% threatened level that we heard from Liberation Day tariff, right? So that is the market's like broad baseline expectation. Now, what would we expect on the back of that happening? Not a lot, right? Because that is what the markets are expecting. A lot of that has been priced in. The markets have gotten used to the idea that we won't get that worse than expected outcome. So I wouldn't really expect a lot of flow coming out of that. We might see a little bit of downside for equities, a little bit of downside for treasuries and the dollar if we get that reimposition. But as long as it's not crazy numbers, as long as it's that 10% baseline, the markets should, quote unquote, be able to look through this fairly simply. Now, where I see the biggest chance for reaction from the market is obviously if we get something a lot more gnarly or a lot more positive. So what would the worst case scenario be? Well, a worst case scenario would be no deadlines at all, with the US taking a massive hard stance, and we get a snapback of all the Liberation Day tariffs. That includes like the risk of a potential 50% reciprocal tariff on the EU, for example. If we get that worst case scenario, what would we expect to happen? Exactly what we got from Liberation Day. Downside dollar, downside treasuries. That means upside yields, of course, downside equities, and upside gold. That's the exact playlist that we had going back in April, and we would expect that to basically play out again if we get that same type of risk. Possible plays there would be further upside in the euro dollar, further downside in dollar yen, and potential short-term downside in US equities as well. That'll be according to all of the many investment bank reports that I've gone through over the course of the last few weeks. That is like the favorites, I would say, for the markets right now in terms of how to play that worst case scenario outcome. In terms of the best case scenario is that we actually get more deals announced. Imagine that, right? Imagine we get something like a deal announced, even if it's a mini deal like we had with India. Imagine we get a mini deal with the EU, a mini deal with other places like South Korea or Japan. If we actually do get some solid deals on the table and we have the other countries being capped at a 10% or maybe even lower base rate across the board, the markets could view that as a positive one, right? So if we get a couple of deals and we get baseline, that'll be positive. If we get no deals and no deadline extension and just that broad 10%, that falls more in line with that overall expectation for the markets. What could we expect if we do get a couple of solid deals being announced and a lower than expected cap? Well, obviously just the exact opposite to this, right? We would expect upside dollar, upside treasuries, that means downside yields, upside equities, and potential downside for gold. Now, the play on that would be the exact opposite of the favorites, right? The favorites on the worst case scenario would be your favorites on the best case scenario, just the opposite direction. So you would expect upside dollar yen, downside euro dollar, and upside in US equity. So that is just a broad framework that I'll be using as we wait for that imminent release of just an insane amount of tweets and comments hitting the wires on Wednesday. Now, in terms of events that we can actually plan for, as opposed to having to wait for, the imminent tweets that get sent out, is we've got two central bank decisions coming up this week, which could actually be a little bit more interesting. We've got the RBA coming up on Tuesday, and then we also have the RBNZ coming up the day after that on Wednesday. So in terms of the RBA, this one is going to be interesting. The markets are widely expecting the RBA to cut rates again. You can see the markets are currently associating about an 98% probability of a cut. So it's in the market's view, it's a done deal that we're going to get another cut. Why are the markets so sure that we're going to get another cut? Well, firstly, the RBA surprised the markets with a surprisingly dovish tone at the prior meeting, right? Upping the risk of inflation falling faster than expected, talking up the possibility of even discussing a 50 basis point cut at the time. Everybody's just like, wow, nobody expected that to happen. That was the trigger for the markets expecting or pricing in more cuts for this year in the first place. What are some of the other reasons why they're expecting a cut specifically for this week? As well, economic data, right? We had GDP for Q1 disappointing at, I think, 0.2% quarter over quarter, which was well below expectations. We have inflation last week showing a further cooling. We had the weighted CPI coming in at just 2.1% year over year. So that undershot expectations. It's the softest that we've had in what's it been 4 years now. The labor market has been softening as well. We had that unexpected contraction in May. We've had consumer confidence, business confidence weakening. So there's a lot of reasons, right? And obviously the RBA, If you compare them to any of the other major central banks, they've been a bank that's lagged their peers in terms of cutting rates. So the markets are expecting them to take a little bit of a catch-up run, if you will, in terms of cutting rates. So based on the market's expectations, what is the best case scenario for possible volatility? Well, the one that we would expect no reaction from is if they just cut rates by 25 basis points and they say the exact same things that they did last time around. The markets wouldn't really react negatively to that because that's information we already know, right? So what could trigger some either upside or downside for the Aussie dollar? Let's start with possible upside for the Aussie. Keep in mind, the markets have already fully priced in 3 interest rate cuts by the end of the year. How do we know this? Well, we take a look at interest rate data like this. We can see that our year-end implied basis point, right, for the last meeting of the year is sitting at negative 77 basis points. Remember, every central bank move is normally in increments of 25 basis points at a time. So if we see 77, that means the markets have fully priced in 3 interest rate cuts by the end of the year for the RBA. Now, why is that important? It's important because let's just say they do cut rates, 25 basis points. But they push back strongly against the idea of cutting twice more as the markets have priced in. That can obviously be seen as a hawkish cut. So they're cutting rates, but if they say, listen, you guys have priced in 2 more for us this year, we're not there yet. We are nowhere close to that. That could obviously be seen as a hawkish cut. I think out of the 2 possible scenarios, that's probably the most likely one. I don't think they push back. The one that could see some additional downside pressure being played into the Aussie is if they cut rates, but they give a stern warning that more cuts will be coming, right? Because we've already got 3 cuts priced in. Think about it this way. We've got 5 more meetings until the end of the year. If they cut if they cut this week and they signal that 3 more cuts are coming, it's very much doable for them to cut 4 times. Including this week by the end of the year. So if they come out and they push that dovish rhetoric that we had last time round, talking up the possibility of maybe doing even bigger slices cuts again, like 50 basis point cuts, those types of things, that could create some additional downside pressure for the Aussie. We did see from a positioning point of view that the Aussie was pretty stretched on the short side from a positioning point of view with last week's data. That can mean maybe we see a slightly smaller reaction in the Aussie because the markets do already look fairly adequately short. But keep in mind, we won't have updated positioning data until tomorrow after market. The reason for that is with the US holiday that we had, 4th of July, the CFTC has basically pushed back the release until Monday. So we'll only really see this data for Tuesday's trading session. Which by that time it might actually be a little bit too late for this. But anyway, with last week's data, we had the market's already firmly short the Aussie dollar. So just keep that in the mind as a reason for why a dovish decision might not have as big of an impact in the Aussie. But as a bare minimum, you would expect a little bit of downside in the Aussie if they do strike a more dovish tone and the markets react by pricing in an additional cut for this year. The other one that we have coming up the day after that would be the RBNZ. Now, for the RBNZ, the markets are expecting the exact opposite. There, the markets are more sure that we're going to get a hold from the bank with about an 80% probability price for a hold and about a 20% probability price for a cut. Now, why are the markets expecting a hold from the bank? The exact reasons for the RBA, but just the opposite. Economic data. The data has been much better than expected. Q1 GDP rebounded more than expected at 0.8% quarter over quarter. The unemployment rate remains elevated at 5.1%, but the labor market hasn't seen the same type of deceleration like we saw with the RBA or with the Australian data. Inflation has edged up to 2.5%, so it's still within the bank's target band, but it's not low enough for them to want to continue easing the way that they've done. And also keep in mind, the RBNZ, unlike the RBA, they've already cut rates aggressively. They've cut rates 6 times in total so far, right? So they've already brought rates lower by well over 2%. So it's a good time for them to just take some time, take a pause, assess the situation before they go again. And they have recently stressed the need for more flexibility, more data dependence, suggesting that they are in no rush to cut further without having very clear economic reasons to do so. And right now, it just doesn't seem like the data warrants them to cut again. So how could this, what could we look for then in terms of a reaction? Look, if they cut surprisingly, that's going to create a lot of downside for the Kiwi, because there's only a 20% probability associated to a cut. But again, it would be very strange for them to do that. If they stuck to a hold and they say the exact same thing that they did last time around, you wouldn't expect that to have really a big reaction in the markets. But keep in mind, by the end of the year, the markets have already, or is still pricing in one more cut for the bank this year. So in my view, the most attractive opportunity that we can get for the Kiwi in the week ahead is if the bank obviously holds rates steady, but they signal clearly that, you know what, we think we're done cutting rates for now. We don't see scope or a reason to be cutting rates more this year. Basically, if they try and tell the markets that that cut that you've priced in by the end of the year, we don't see that cut happening right now, that could be a good opportunity to look for some upside for the Kiwi dollar. Now, how we can look to express this is I still like the Aussie Kiwi pair to the downside. It's been a real solid mover lower recently as the markets have priced in that policy divergence between the RBA and the RBNZ. So if we get the RBA striking a more dovish tone on Tuesday and the RBNZ striking a more hawkish one on Wednesday, we could be much lower at that time. We've got a couple of huge levels coming up. The first one is this 107.80 key support level from that recent June and July support level that we have. Below that, we've got that 107.40, which is the low going back to the 2nd of June. And below that, we've got that series of lows around the 106.60 levels. So we've got some key levels to aim for to the downside should we see that materialize. The one thing that kept us patient, we mentioned this in last week's week ahead, from not trading this lower already last week, was just that huge rush that we had to the upside in copper, where that because we have the Aussie and copper normally correlated with each other, you don't want to be too aggressive in Aussie shorts when copper is ripping higher. But the good news for those who want to be short the Aussie like I do is that we had copper rolling over going into the backside of the week, right? If you take a look at what happened to copper, all of that upside we had was wiped out in Friday's session alone. So if you go to the correlation there between the Aussie and the and copper, you can see that that downside move actually followed through with downside in the Aussie as well. So with copper wiping out those gains, that's one less thing to worry about for downside opportunities in the likes of the Aussie Kiwi. And this will be a key one that I'll be focusing on in the week ahead for those key economic releases. And then of course we need to watch equities, the dollar, yields, gold, with all of the tariff nonsense that we will no doubt be getting throughout the week as well. So with that said, hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know.